decide to go live that it connects the YouTube channel?
No, let's do it. That's the only way I can get into Zoom.
Okay.
Because see how it says green chart in the corner?
I can't see what you're seeing. Decide to go live that it connects the YouTube channel.
All right, we're live on YouTube. That's the only way I can get. All right, let's go ahead and jump in and get started. Thanks for being here, guys. Welcome to the Market Pulse podcast, coming to you live right now. And yeah, I've got some exciting stuff to do. Today is our Friday real estate forecast day. So we are going to cover some exciting updates in the world of real estate. And frankly, there's a lot to cover. The world of real estate is looking more grim by the week and the month. And that's why I like to do this at least once a month. So let's get the disclosure out to make my attorneys happy. And we'll jump in and get started right away. Thanks, guys. Gosh, I remember that sweater. I remember when it was cold, and I'm not looking forward to the winter again. Gosh, it feels like summer went by so quickly. Anyways, there's a disclosure, like and follow, guys, share with your friends. You know, I've actually sent our podcast to multiple real estate agents, gurus, and investors. And these guys check in and watch my stuff now every week because I'm about a week ahead of the news on most of these updates. And today, I'm probably right on the verge. Most of the research I did today, in fact, I would say it's probably the most relevant data that exists. It's less than 24 hours old. So what we're going to jump into today, just to get things started. Good morning, everyone. To get things started, let me give you kind of the premise or the outline of what the agenda looks like today. So we've got a lot going on in real estate. I'm going to do some reviews first on like cost to build. So what has happened to materials and material costs, because this is a good indicator of inflation, either going up or coming down. And every market's a little different, right? If you guys remember, there was kind of that weird egg thing that happened over the COVID, where eggs were like 8 times the normal price. It was just ridiculous, right? But it was a very specific market because of supply and demand, and housing is exactly the same. Just because the Fed's raising interest rates doesn't mean that it affects inflation on every market the same way. And so we're going to take a look at costs, some base costs for building and homes, to see if inflation is starting to, kind of bring down that sector, specifically in the real estate market. And then we're going to do a light, well, I wouldn't call it a light focus. We're going to do a dive on California, because California is about to blow up. I would say it's probably the housing market that's the most susceptible to blowing up. And my prediction is people are being blindsided by the data, by certain parts of the data, and that's all they're hearing on the news. But there's some points of the data in California that is unlike any other state, almost the worst of the country. And I'll show you why my math and prediction likely will play out a certain way that will be driving down the prices in California. Now, obviously, there are certain areas and regions that aren't going to be as affected as much, but we'll get into that also. And then last but not least, we're going to be going over, there's 2 pieces of data with real estate that I thought would be interesting. We're going to look at Yellen's claim to this money laundering that's happening in the real estate industry, even though in my opinion, the amount is not really worth looking at. And then we're going to take a very quick dive and update on the CREs, so the commercial real estate world, and how that's starting to crumble and what the likely effects are going to be. And the most important part for the people who watch this channel or check in within the next couple of weeks is really to give you a sense of what can you do about it. Like, how does this impact me? if I'm making some life decisions or big decisions, like what should I be looking for? And that will be my goal or my intention set for this webinar is like, let's bring it home. And how does this impact me? And what can I do about it so that I can continue or begin to increase my wealth or help my financial situation? So let's dive right in. I've got so much to go over. I'm trying to think how I want to do this. I've got so many images I want to share with you. Let's just jump right in, and I'm going to kind of click back and forth with stuff. But I'm going to open a couple of these, and then you guys can. We're going to start with the first 7 images I've got here. So the first thing I want to talk to you guys about, let's see if I can get this to go away, is this. And what we are looking at is for home cost, lumber is actually one of the large indicators. I know it sounds bizarre. I mean, service, the cost of labor, appliances, cement largely is regional, but lumber prices nationally are something that you can track. And this is actually the chart that shows lumber prices year over year, the last, even through COVID, in fact. And what I want to show you is you can see on this chart dated way back even to 2016 that lumber prices were just at or below 400. And the way that this measures is this is per 1,000 cubic feet, I believe. So, oh yeah, there it is. Lumber USD over 1,000 board feet. And so this 495 figure, this is just like a total cost per 1,000 board feet at like a wholesale price, not how it would get delivered to your door, right? And so you can see that the price through COVID just went insane. I mean, it dropped a lot when COVID hit and everyone kind of contracted and was like, no, we don't want to buy anything. So lumber prices started dropping because supply started stocking up, demand dropped completely. And then when people started building and fixing stuff in their basements and working on homes, moving out of states and cities that frankly people were afraid of, that we started seeing these spikes. And then we saw a large spike, and some of this was seasonal, but just imagine all the pandemic hype added with the seasonal waves, right? Because there are seasonal waves with lumber. And that's what created this just insane pricing. And right now we are at the floor. You know, for those of you who trade or invest or work with charts a lot, right now we're sitting on the floor of the last 3 years. And you can see that we're kind of hitting that support level. You know, I would call it a support level of like 500 or, you know, give or take $20, but you can see how much it's bouncing off of this price. And because we're in summer and we're heading into winter, probably one of the lowest demand seasons for the year, my prediction is that lumber prices drop well below 500 and that we will probably see prices in the 400, maybe even 350 range, which would significantly do what? Well, if you're someone looking to fix your basement, if you're someone looking to build, prices are going to get cheaper. So is inflation working? Well, I would say yes. And when I say inflation, is our fight against inflation working? I would say yes, but we were fighting inflation, you know, even back into this big dip that kind of happened right over here, right? But generally speaking, it's testing this support level. And I would say our fight against inflation is working. The rise in interest rates is putting a lot of pressure on building and new homes in general. And so I would say this is going to drop out. I would say this is going to fall, thus putting pressure on the real estate market as a whole. And this is nationwide. This is not just per state. So what does this mean when we dive into a specific geographic area? I want to show you guys, see if I can find this chart. I want to show you guys California. We're going to do a really quick look at the state of California because I believe that California is in trouble. So one of the things that's happening, and you can see it in this chart, is declining inventory. There's a trend with homes for sale dropping about 23% year over year. Now, if you are in real estate or you understand supply and demand, you would go, well, that's a good thing, right? This is an amazing thing. If sales inventory growth is negative 23% year over year, my house value should be going through the roof because there's no supply, right, Matt? And it's like, yes, I get that. I get the concepts and the principles of supply and demand, but we have to do a deeper dive to figure out why. Why is supply so low? And what's going on in California that the sales inventory is the amount of homes listed from, and it can include new homes, but it generally includes homes that already exist that are being listed on the market. And a 23% drop statewide, you would think would put tons of pressure on the market, right? It would put a ton of pressure on housing and pricing to start dropping. And although the inventory is dropping, there's another chart that's scary, I would say, to combined with this. So the decline, also, I think it's worth mentioning that the decline is the 6th worst in the country. So California's decline in inventory is the 6th worst, meaning the amount of homes for sale, there's like if you're to list out the most demand, states with the most demand from top to bottom, California would be number 6, meaning they need homes to fulfill on demand. But there's just not demand. That's the bizarre thing, is even though supply has radically dropped, check this chart out. You guys are this is all gonna come together here. So this chart, this is reversed, the supply and demand, and you can see with home growth. So this is the home value versus inventory. If you see California number 43, you've got that 32%, right? And sales inventory growth, negative 32%. But you have this negative 4.4% in home value growth. So what does that mean? It means that the cost or the average price that's being sold in the state has actually dropped over a year. So the rules of supply and demand, guys, are breaking. And by the way, this is happening in so many markets right now where the rules don't make sense. And that's often good reason to do nothing. In fact, that's probably one of my biggest tips, is when the rules don't add up, or when 1 + 1 = 3 or 0, you need to step back and go, what's going on, until you can figure it out. And I've dissected this because of this. I saw this chart and I'm going, wait a minute. Rule of supply and demand is, as supply, right, goes up, what happens? Prices fall. When supply drops, what happens? Prices rise. What you don't typically see is home value prices dropping at the same time inventory is radically dropping. And so to have both is a very unique, we'll call it an opportunity, because if you can see the truth of it, this may be one of the largest opportunities in real estate that's stacking up, that's happened in over a decade. So if you're someone who's been looking to get in and started in real estate, or you're wondering like, when's a good time? This is going to flush out a lot of players, participants, people that shouldn't have bought homes in projects that did not make sense. And if we start to see, I'll get to this, but if we start to see mortgage defaults, which is my prediction, that's going to free up a ton of inventory, specifically for California. And this 4% year over year drop is going to be like 10, 15, maybe 20. I'm actually predicting in some areas 30 to 40% drops in the state of California. So let me get over here. Let me show you kind of what I've got next on here. But I think I've kind of talked about this. The price declines, they obviously vary from county to county. We're seeing lesser declines in areas like San Diego, so like the very southern tip of California, where areas like Northern California near the Bay, where typical home prices are, I mean, right now they're down like 10% average. In fact, I'll show you some where it's way more than 10% average. Let me show you this really quick. I think this will kind of help piece this together. Share this chart. So this chart, oh, where'd she go? Nope, that's not the one. Not the one. There we go. Sorry, I have a hard time seeing all this. You can see the San Francisco area Bay has dropped about 10%. But when you dive in to some of the details in San Francisco, especially like downtown, it's a good indicator for what could happen to outlying cities, states, etc. Right? In fact, in the last bubble, if you guys remember 2008, when the housing market crash happened, California, Arizona led. And when I mean led, not led in a good way, they led other states, and Utah was actually one of them. But I'm in Utah, by the way. That's why I say that. There's some new nuances I'm going to show you at the end of this, where it's actually, I think the timing and the drops are going to look different, where you're not going to be able to look at California and go, oh, that it's happening. The drop's happening. It's clearly showing up. Well, maybe, right? So let me bring this in. Look at this zip code in San Francisco. So this is a region in San Francisco. And if you've ever been to the Bay, this should look familiar, right? The bridges that go across. But this is like right downtown, and you can see the home values, and you can see a bunch of them, by the way, negative 14%, negative 16%, negative 12%, negative 13%. You can see a strong growth in like this weird region up here, but that's because there's not a lot of residential anyways, but negative 19%. And this is things just getting started. So what's going on? Well, you've got a lot of people going, wow, that's the Bay Area. You know, politics are crazy down there. Commercial real estate's awful out there. You know, people are fleeing because cost of living is, yes, I agree. But as an indicator, you could take a percentage of that and go, well, if it's happening there, it's probably going to happen in other areas. And this pattern that I've kind of woven together, this reveal, you could call it, I think it's going to play out for most of the country. And I'll give you at the very end, depending on what state you're in, I'll give you kind of a sense of like how bad it could be, and which states, frankly, I don't know if they're gonna have to worry at all. There may be drops, but the percentage or the shift in change percentage-wise is just not going to look the same. So there's this perception versus reality that I think is valuable to get, where despite low inventory, many people believe that price declines are over. In fact, I've talked to agents. I've got family out in California, and people think the market crash is over. We're saved. Jerome Powell did his job. The soft landing happened, and there's no more impact that's going to happen specifically in the real estate market. In fact, I've had people, agents, real estate agents, tell me, Matt, like things are great. The real estate market's growing. It's still booming, and it's like, what? Like, where are you getting your data? Most of the country, most states in the country have very little, if not negative growth year over year. Most states. And so I don't know what, there's this illusion going on. And there is kind of this perception due to this seemingly strong housing market that has increased buyer demand. Like there's this weird thing going on that I think specifically people in California are disillusioned to sell. They're holding properties that they normally would sell, but they're holding because they have equity. They have equity, but they can't get the price that they wanted. They want the price to go back up to where it was, or it's been sitting on the market for 90 days. And they're like, wait, what happened? Because they got so used to the COVID crisis where things were just flying off the shelf, and now they're holding it and frankly becoming I would call it house poor, where the amount of, and we're going to talk about this at the end also, the amount of debt that the average household has versus how much their mortgage costs versus their annual income is at scary record numbers. We are nationally at, and I'll kind of tip you off before we keep going into this, but nationally, we are at a all-time high in household debt, credit card, and ancillary non-tied debt, right? Debt to assets. I'm just talking about like frivolous debt. The debt is higher per household than it's ever been. And the cost of living, so like how much it costs to service your mortgage, pay your taxes, and the amount of income, the percentage ratio is higher than it's ever been also. And what that means is that the percentage of my annual check that I put into paying for my house every year, percentage-wise, it could be 20% of my check, 40%. In some states, it's 50, 60%. And I mean, just imagine, I don't know how they do it. How do you have 60% of your income, your like how much you make going into your house and you survive? And people go, well, it's because I got all this cash and like it's worth, you know, all my wealth is in my house. And it's like, yeah, but if people aren't going to start selling it and you can't get the money out of the house and the banks aren't willing to give you the credit because they also are tightening up, then there's this illusion is really what I'm saying. And it hasn't caught up, meaning it probably is going to hit in 2024 where people start waking the freak up and they're like, oh my gosh, like I should have sold last year. I didn't know that the inventory pileup was going to create this much of a downside, especially in specific regions. Let me bring up this chart. This was from, where did I get this? Oh yeah, California Association of Realtors. So this is a really interesting chart because it's showing the existing homes sale change, right? The one that we showed, the negative 32.9% year over year. And the amount of homes, the median sales price is 838, just shy of $1 million. Unsold inventory index is 2.2 months. So like things are still moving and median days on market is like 15 days. So like when you look at it this way, it's like, no wonder I'm disillusioned. Everything's fine. All's well. And then if you look at this is where things start to get a little scary and how it has me see how fragile the housing market is being propped up. Because one of the data points, and we'll get into this a little bit later, one of the data points that's holding everything together is even if you're strapped, right? Even if 50, 60% of your check is going towards your home, everything's fine until what? Until you lose your job, until like you have an issue with like you're making that payment, right? And right now, the unemployment is so low. People lose their job, they get another one in a month or two. And so it's not affecting our monthly ability to pay for things, specifically the housing market. This is sales struggle to gain momentum as mortgage rates rise again. And so this is just the same data that I was showing you earlier, but more over a period dating back all the way to 2009. And to give you an idea on where we're at, this, guys, looks and smells like 2008. And this data specifically, if you look at this line and you look back to when it's been this low, when our year over year gains have been this low and the inventory has been this low, look at when it happened. Yeah, I actually saw a video, not on this in particular, but it showed the parallels of data that's happening from 2008 to today. And everyone's like, oh, it's not the same. It's not the same. I get it. I get that subprime mortgages aren't going to be the domino that kicks us over. But was that really the problem? Like if rates had gone up and people could have afforded to pay for them, they would have kept their house. So really, this is an affordability issue. And this is how I weave this thing back in to kind of give you guys what is going on and what to look for. We're talking about affordability. And when you play with any variable that makes something now not affordable, something happened, I lose my job, or my credit card interest rates go way up, and now my debt to service that cost me a bunch more, or, fill in the blank, right? There's lots of issues around this. But when you look at 2007, 2008, we are sitting, I mean, you could almost say outside of COVID, and COVID only because of the stimulus, we bounced back. But you could say that the data looks and lines up very similar to 2008. In fact, my business partner, Kevin, I remember sitting down right around May of 2020, where we sat down with our entire group of members and started laying out this data. And then all the stimulus started getting cranked in. And had that not happened, none of the spike that you see here in May 20, right here, none of that would have happened. None of it. Because without the stimulus, you wouldn't have had all this extra cash and combined stimulus with low rates. Now we have high rates. And do I think there's going to be stimulus? I don't. I do not think that this cabinet is going to, or even presidency is going to have an appetite to give more stimulus, because right now, one of the main topics around who's going to get elected is fiscal responsibility. And no one's been that. I'm saying both sides. Trump was not fiscally responsible. Biden was not fiscally responsible. In fact, you can go back, my last episode, I showed a chart of Democrat or Republican. They're incentivized to give out handouts. That's just what they do. And so this is a strong indicator that seems backwards, doesn't it? It's like, how in the world, when we had the lowest on record inventory in 2007 to 2008, how did this thing blow up? It's the same thing. It's the illusion. It has to do with our sentiment. And if we think all's well in Zion, and we don't go out and spend, and we don't go out and sell off things when they're overvalued, we call it marked to market. Like, we don't actually do that work. Well, and I would say it'd be really hard to do that right now. I would say most individuals, most households don't have it's not a mental capacity issue. It's like they just don't have the tools to really figure this data out, because it's really confusing. And the main variable is inflation, because it seems like things have been going up, but that negative 4%, that 4.1%, or what was it on the California one? 4.4. That is on top of inflation. So the actual value of homes has dropped significantly. It's just the number, because of the inflation in the dollar, has actually been a lot less. In fact, here's a fun story. So I've had this here for a while. I don't know how many of you guys have seen this. I'm going to put this here for you guys to see. I need a place to sit right here. This is actually a really cool piece that goes really well with what we're talking about. But this is my Zimbabwe dollar. This is how many zeros we got there? I think this is a trillion. Yeah, this is a $100 trillion bill, $100 trillion bill. And I need to get it to straighten up. But Zimbabwe went through what's called hyperinflation. And that's what the feds are actually countering. And they're actually doing a good job. They're keeping us out of continued inflation, hyperinflation. But what happened in Zimbabwe is there was so much inflation so fast that people would go to work and they would, in the break, go buy stuff. So they would take their break, take all their employers wouldn't even have employees, because employees were demanding, if you don't pay me 2 times a day, I won't even work for you, because that's how fast inflation was happening. So people would work half a day, get their cash, go out for lunch, buy as much stuff as they could with it, and then go work the other half a day, because in a day, a burger literally added a zero. That's how fast there was one piece of inflation, where they went from a burger cost 10 trillion, and then the next day it cost 100 trillion. And then the whole thing blew up, because it's just paper, right? It's just fiat currency, just like the dollar. And what happened at the end of the day is it was cheaper to burn the stuff than it was to hold on to it, because it just lost its value. The unique thing about my little plaque is it's got a 1 troy ounce of silver, which is a representation of real value, right? We have to be looking at real value. And houses, fortunately, real estate has real value. It's a great hedge against inflation. but these drops in prices actually indicate deflationary periods. It actually indicates that the raise in rates is actually creating some deflation in the market, specifically housing. So we have some affordability issues, right? High California prices combined with a 7% now mortgage rate makes homes just completely unaffordable. And let me just show you like a very light, if you don't live in California, and I don't anymore, but this, let's see, where's my picture? Oh, I've got to load up the rest of them. Let me load the rest of these up, guys. But California is a mess, and you just don't realize it until you see it. And then you can kind of go, oh my gosh, like, could that happen to us? It's like, yes, that definitely could happen to us. In fact, I would say it's very likely. It's just more of like, what percentage of this will happen to us? Where's my webinar at? There we go. So let me share this really quick. This was just an example of a fun listing that I saw on Zillow, and you can see how unaffordable this is. So just take, I mean, this is LA, but just take a basic 3-bedroom, 2-bath in LA, 1.19 million. That's $2 million for a house. If you were to put a 20% down payment on that, your monthly cost estimate with taxes and everything else is around $8,000. It's actually $8,174 a month. Completely unaffordable. But you go, oh, but Matt, everyone makes more money in California. It's like, yes, I understand that, but not proportionate to the values of the real estate. It's just not. It's completely unaffordable. And this is the tipping point, we could call it, that I'm really watching closely, is affordability. It's a new metrics. We've always had it. We've always had access to, but it's a new metrics that we can watch, a new indicator that we can watch that I think will actually show us the tipping point in the real estate market. And it's why I feel like I've been calling the shots and been right over the last year as I've been doing this podcast and other events, because I'm not looking at the same metric. Everyone's like, oh, well, 2008, let's compare it. It's like, no, there's something new going on here, clearly. Like, yes, inventory, same numbers, demand, same demand, by the way. In fact, one of the other stats I saw nationwide was during 2008, the demand for homes. There were all these stats out like, we don't have enough houses for the growing population. We don't have enough homes for people. And then somehow, since 2008 to, it was like 2012, when things started recovering, there are plenty of homes. It's like, how did this happen? And it's because people have second homes. How many people do you know that have a second home? How many people do you know that are in the Airbnb business and they bought a house for probably way more than it's worth, but because they're renting it out daily or they're renting out weekly or monthly, they can afford an $8,000 payment, right? Because if you're renting this out for $3,000 a week, and people are willing to pay for it because it's it's in LA, it's maybe a vacation area, whatever, it makes sense. But there's two factors that I've been watching really close around we call it like a short-term rental market. Two factors. One is the demand for stateside vacations going up or going down? And I just want you to think about that for a second. Based on COVID, based on lockdowns, just look at your life. Like, where did you go on vacation? And the percentage, do you think more people did staycations, meaning not like in your own house, but like they went somewhere, they went down the street, or they went to the city, or they went to the state across the border? And you remember with international travel during COVID, borders would lock down. People would lose their trip. And so there's kind of this fear of like booking a trip, like I don't know how many of you guys are watching what's going on in Hawaii right now, but like Hawaii has asked people not to come because it's on fire. Same idea. We were on fire, but it was COVID and the country was asking us not to leave. So all this staycation or keeping vacation money inside of the country was what was happening the last couple of years. So Airbnb rentals, if you're in that business and you saw, your occupancy going through the roof, you're raising your rent rates, you're going, oh, I should buy some more properties. This business is doing great. Well, then what happened? Rates start going way up. People's ability to go vacation goes down. I would even say that the demand for people to work in offices had a lot to do with this also. People were like getting Airbnb rentals and working from home, and businesses also aren't playing into that. So we have multiple factors that are playing into the short-term rental market. And frankly, the data in so many aspects, I could argue this all day, but the data is showing that like that industry is going to get hit. And so a lot of people are making the argument, and I did this a month ago, made the argument like, well, but it only makes up a small percentage of the inventory. I get that, but affordability is going to be the thing that drops that market, and affordability is going to be the thing that it will cause mortgage defaults, basically, in the real estate market. So let me bring this up, kind of moving into my next thought on this. Oh yeah, let's talk about this. So median household income in Los Angeles is only $82,000 a year. So in that example that I brought up, this example here, the average person in LA is only making $82,000 a year, there's no way they're going to be able to make this payment. Do the math. $8,000 a month is like $100,000 a year. So this house in particular, 1,500 square feet, is over the price of someone's annual income at all. So it's like, even if you didn't eat and have any other expenses, you couldn't afford this. It's ridiculous. I want to show you guys a state-by-state map. So if you're not in California, you're not in Utah, you haven't heard your example, I'm going to bring up your state right now. This will be a good illustration for any of your family or friends that may be in other states. But this is a map that shows the value. So this is affordability metrics by state. And what this means is it takes the average income of the state. So what's the average annual salary or income per individual in the state? Takes that number, and then it puts it over what is the average price of a house. Seems pretty simple, right? Average income, average price of a house, put one over the other, it gives us a percentage. Well, those in red are the ones that are least affordable. So the states in red are the least affordable if you live there. And everyone goes, well, if I moved to California, I'd make a lot more money. Not proportionate to your cost of living. I'm sorry. It just doesn't work that way. It's a bad argument. California actually would do these ads when they were trying to drive people into the state back when Arnold was governor. And it's not true. 65%. If you live in California and you were to buy a house, the average cost of a house compared to the average cost or average income is 65%. 65% of your check is going to your house. Do you think this is sustainable? This, by the way, this number is worse than 2008. The affordability in almost every state is worse than it was in 2008, meaning people are more house poor than they've ever been. And the only reason it's staying propped up is because unemployment is at an all-time record low. So you kick that domino over, unemployment rises, combine this data is not, affordability isn't going to change overnight. And what happens? Mortgage defaults. So you take states like California will be the first to go, Oregon, Washington, Montana. Then you kind of get into these orange ones, Florida, Colorado, Idaho, New York. These will be the first, in my opinion. Now, obviously, this is not financial advice. Don't make some crazy trade based on this because of my research. Do your own research, but these will be the first to fall. They will be the first to have the largest mortgage defaults. Therefore, huge influxes in supply, forced supply, not stubborn supply, right? Like right now, California is being very stubborn, and it It's not sustainable. We're seeing it in some of the metropolitan areas, specifically the Bay Area. Then you get into the yellow areas, which is places like New Mexico, Arizona, Utah's included in this, and they're just under 50%, guys, just under. If you looked at this state, and I'll show you this, pre-pandemic, a lot of these states were in the 20%, like 20 to 30%, meaning 20 to 30% of your house payment or total cost would be from your check, only 20 to 30%. These in many states have almost doubled. And I actually live in one of them. And we're going to talk about that because you look at this and it goes, okay, this is probably how the mortgage default suite's going to happen. But the houses that are just purely going to have price drops because they climbed the most, the unaffordability climbed the most, are actually the states I think are going to have the biggest drops. And this map does not clearly show that. Utah is actually like number 4 worst state in the fastest inclines in affordability, meaning we went from like 20 to 40% in 3 years. It's just ridiculous. It's not sustainable. And it was propped up by people in California and these other states that had tons of equity moved over. But the amount of income that people are making here is just not, it hasn't changed much. It really hasn't gone up, even with the people in California moving over. So I want to show you this mortgage debt by state, and this will give you also another reason why I think California is in a lot of trouble. But before we do that, I want to show you some evidence of why I think buyers are stubborn. This is here we go. This is a chart. Let's see if I can blow this up for you guys. This is a chart, again, that shows in California the number of new seller listings, but over the course of a few years. And you can see that we've gotten last year, this dip, California had one of the lowest seller listings ever recorded, like ever. Even 2008, it dipped lower. And then there was a spike that happened, right? And then there's probably going to be another drop in inventory like following this. It's just this weird phenomenon that's happening. But this is not sustainable. There's no way for this to continue to stay this way. And if supply stays low, the only thing that will happen is that, 65% affordability is going to go to like 70% or 80%. And it's like the state is going to collapse. People are going to flee at a record level if things don't shift. And what that will typically impact is people's jobs. People will need to leave their jobs, they'll quit their jobs, or they'll move to somewhere where they can make more and spend less. And it'll be forced. Or, I mean, California does. The alternative is more people just start living on the streets. And California is, unfortunately, an example of where that is happening a lot right now. Okay, here's the mortgage debt by state. Show you guys this really quick. I wish there was a quicker way I could bring these up. This also shows California's mortgage debt by state. Now, this is accumulative. This does not factor in by person, like how many people. But I want to give you an idea how bad California is, meaning how much mortgage debt. So a lot of people would make the argument after hearing this, well, Matt, people just own their houses outright. They've got so much equity. People, they're just, so fluid that there's nothing, the money and the equity is in the homes, everything's going to be fine. No, not only is that story completely false in California, California is the worst, meaning there's the least, based on this data, likely, I mean, this doesn't say it specifically, but likely the worst equity position in homes in the state out of all the states in the country. And this is why California is really bad compared to like maybe the drop that may happen in other states. $2.2 trillion in mortgage debt. Texas is second to that. people would argue, well, there's more people that live in Texas or California and Texas, but it's not 2 times. It's not this big. And New York is 0.72 trillion. Yes, I get California is a huge state, massive population, but it is not 2 times the size of Texas and Florida. So this gives you an idea from a positional standpoint, the equity, which in business or in a startup, you would call this runway. This and how long this is kind of inverse. You guys know what runway is, right? Like when you take off on a plane, you need so much runway to make sure your plane gets off. And the more runway you have when you land, the easier it is to land your plane. I don't know who made this stuff up. Why we talk about the economy through the eyes of an aviator, but we do. And this, in my opinion, is an inverse runway chart, meaning California has the least runway when it comes to holding its prices. And that's probably why we've seen, even with insane demand, record low supply, like supply that dates back to 2008 even, and we still see a negative drop year over year. This is why. It's because people in their homes don't have runway. And what is runway? It's my ability to go to the bank and say, I need to pull some cash out of the equity in my home. I need to be able to use some of my wealth that's in my home for an alternate reason, or get another lien to help get me by when I hit unemployment. This is why. And we haven't had the unemployment dial kick. It will. The charts show it, and I'll show it to you in a minute. Historically, it's going to go up. You add that with this, and it's like a plane. It's like a commercial plane trying to land on an aircraft carrier. It just isn't going to happen, right? Can you imagine this thing coming down and it's like hits the aircraft carrier and it just falls off? I mean, that's what we're dealing with. We're dealing with a lack of runway. And this shows the amount of mortgage debt that's the problem. And that's why I say this is an affordability issue. And one of the key indicators, metrics, whatever, is mortgage. It's being house poor and mortgage defaults that will happen in the future. And it won't be caused by some ARM loans. It's purely affordability. And the affordability metrics look very similar to 2008. All right, so, oh my gosh, I've only got 10 minutes left. I gotta get through this. Let me show you one more chart. I wanna show you guys the unemployment, because this pieces this whole thing together. So here's unemployment, and you can see, I mean, this is, guys, we are living in an illusion right now. If you think things are okay, we are at an all-time record low in unemployment. Obviously, this was the spike during COVID, one of the records, the opposite way, by the way. But this is when 2008 happened and we went into a recession and things started contracting. Employers started letting people go. It's already happening, but it's not happening enough. We are at an all-time support. And traders, what does support do? What does support and resistance do? It is a ping pong paddle, right? That we throw a ball at, and what does it do? It bounces on it. Well, it's been testing the support. Well, you can't go much further than zero, right? You couldn't have zero unemployment where everyone is employed and like there's not people moving jobs, quitting, getting sick, et cetera, right? And there's a certain amount of this population that frankly just isn't working because they don't want to. So what happens when we start getting back into some of these old percentages, 5%, 7%, 10%, what happens, do you think, contraction wise, when we have the most credit card debt in the nation per household that we've ever had? We have the least affordability, and in some states, it's insane. And then you have a lack of runway. I just don't see, I have people argue with me about this because I own a bunch of real estate, but I'm not an idiot. I own a ton, I want to say that again. I own a ton of real estate and I'm not a freaking idiot. And what I mean by that is I don't have my head in the sand and I'm not oblivious to what's going on. There's clearly going to be some retraction. I'm not calling a crash yet. We might do some really phenomenal things with AI and employment, but it could go both ways. Some people are saying AI is going to displace tons of jobs. And so that's going to put pressure on specifically the middle class, these like people who could afford homes, but we're a little tight and a little strapped. So unemployment's a big deal. All right, I've got 7 minutes left, and I want to make sure I can get to some of these other topics, but I want to show you guys this chart because this is where I get all my data, and this is coming from Reventure. This is probably one of my favorite charts now in real estate. Any of you guys can go there. I'm going to bring up my data also really quick that I share. But you can see Reventure does this really cool year over year. They call it house payment as a percentage of median income. So that's this affordability metrics that they're using. But you can see all kinds of things on this chart. You can go to your state. You can pick on it. I mean, this is really, I'm doing an ad for these guys. I should get a spiff or paid. I'm not paid. I'm not a sponsor of this group. I'm not introducing them in any way other than I love it. I love this tool. I've been using it. And as I look at investment opportunities in places that are going to be sustainable, and like if I'm going to buy an apartment complex somewhere, it's like, well, I'm probably not going to do it in California. You know, the affordability metrics right now in California are really bad. Or if I'm going to buy and flip something, I'm probably going to want to be in the blue areas because I want to be in a market where people can afford the house, right? There's going to be lower supply still, but higher demand. And so anyways, I do all this, especially if I'm looking a year from now, if I'm building a house, maybe I'm a builder and I'm like going to have a bunch of homes ready by the end of next year. I'd be looking at this quite a bit and my concerns would be the ones in red. So anyways, Reventure app, I get a lot of my data from here. I wanted to give these guys some credit. You guys can go there as well. And I want to show you lastly, let's see if we can get this up. Come on. I want to show you lastly. Oh, no, that's not what I want. My data charts, which I get straight from realtor.com, and I get it before pretty much anyone else gets it. So you're seeing this data, you're seeing last month's data live before most people. Actually, I update this, just so you know, I update this on the 3rd day of the month. And so these charts, they don't exist anywhere on the web. There's no news on them at that time. When I load these about 3 days after the month, by the way, any of you guys have access to this, little plug, you can use your phone, scan the QR code, and it will take you to this chart. And I update this chart on the 3rd day of every month with the most relevant data. But I want to show you, if you're following the real estate market and next month, you want to know, like, better or worse, you could come to this chart even before my podcast and get a sense of like what's happened before the news, before the announcements, before the other charts get updated, and you'll have an edge. And what you decide to do with that is up to you. Maybe we should do a webinar on that by itself, how to take advantage of having an edge, but you'll have an edge. This is median list price nationally. You can see nationally, the median list price has dropped year over year, period. It's just where it is. 440,000 is the number that we're at now. The peak was 445. All-time peak was 449. So we have dropped off of peak. We're heading into winter. So this is just going to go down. I'm trying to gauge how fast, because how fast will set a new floor, and then we'll grow off of that a little bit during spring and then drop down. So this definitely goes in waves, but it's seasonal. There's seasonal waves. So you kind of have to take a moving average. Things are still obviously going up from a, like you could say from an average standpoint, or if you were to put a moving average on this, it would do that. Average listing price has also dropped nationwide, but you can see we hit a new high this year on average listing price. Price increase count is dropping to all-time lows. No one's adding or increasing the pricings of their listing. What they're doing is they're decreasing. And if you've been on any real estate site the last couple of weeks, what you're seeing a lot of is price decreases. Like we talked about, California, they're just living in an illusion. But those who aren't and actually need to sell, they're having to drop their price. And we're seeing that in the listing reports. Median listing price per square foot. People are also, even though the average cost is selling, this is an important note, even though the average cost is dropping, right? So the median price and the average price is still pretty high, but dropping, what you're getting for your square footage is dropping. So how much you're paying, you're getting less square footage. So even though the price is still kind of high, it's in combination with their people are getting less square footage. I mean, that's just what's happening. And so pending ratios is also dropping. This is a great indicator, by the way. This shows listings versus sell, like how long they're staying on the market, how fast they're coming off. And so the more this comes down, the more demand is dropping. So this is really, I'd call this a great demand chart. New listing count, though, is still dropping. This is kind of that stubbornness that we were talking about. We need, in order to actually have the market shift, and everyone's trying to time it. I think we're going to see this tick up pretty big in 2024. I don't see how it doesn't happen. But this is a chart that I'd be watching around like when new listings start to spike, you're going to have this frenzy and sell-off. And you add mortgage defaults to that, people aren't selling because they want to, they're selling because they have to. Average listing count came up a little bit. We're obviously not on the bottom. And the reason, there's a difference between new is dropping, and I want to have you guys see this. New is dropping, but for some reason, average is climbing. So what's happening? It's days on market. Median days on market is back up, and homes are staying on longer than they were during the last 2 years in the dip. And so we're at peak season, here, let's see, what was that, 6, 5, 6, and we just got through it, 5, 6. So like we're coming back into, it's going to be a spike because we're heading into the winter season. How big and the amount of days that homes stay on the market increases supply also. So I get all my real estate data through these charts. It's what builds them, guys. My credit obviously comes from realtor.com. You guys can get the data straight from there also if you like, but I create the shortcut for you. All right, so that is it. That kind of sums up. So to kind of summarize what's going on, nationwide, we're seeing affordability issues is the main concern. And the way it's showing up is in people's ability, their annual income versus their annual housing total costs. That gap is just getting bigger and bigger. People's affordability, our ability to buy, is just getting smaller and smaller. It's contracting. And you have that combined with all this other data and rates being at all-time high, rates not coming down. By the way, there's supposed to be another rate hike by the end of this year. And I just don't see the Feds coming off of that, but maybe there's, I would say it's like if I were to put a number on it, probably a 30 to 40% would be my guess, 30 to 40% chance that the Feds don't do another rate hike. So I'm saying it's possible. I'm saying it's more likely than not that we're going to have another rate hike. And the implications, this is important to know, the implications of rate hikes have not happened. It takes 12 months to 18 months for us to feel the implications of rate hikes. And so we're just starting to feel the implications of the largest rate hikes that happened early on when we started doing this, not all the additional ones. So we have yet to see how much deflation is going to be happening. But you know what? America is a great country to live in, and we're resilient. We made it through 2008. I don't think that this is something that we need to be jumping off of buildings for, guys. We find a way. And I hate ending on a bad note, but the truth is we are just great. Our country is great at innovating and solving problems like this. And I just don't see that we're going to lose that ingenuity and innovation in the next 5 years. If nothing else, this is a great leveling field opportunity for you to step in and say, I'm going to start a business in the next couple of years. I'm going to get into real estate in the next couple of years, because the best businesses are built in hard times. The best portfolios are started in the worst times. You don't want to start 2 years. You would have been screwed. You would have lost all your gains if you had started a business or a real estate practice in the last 2 years. Obviously not as an agent, because you're just getting fees. But if you're building a portfolio and you had just started 2 years ago, it was probably the worst time to do that. But now is the time to start looking at, like, what's a good business I could start? What's an opportunity in real estate I could start taking advantage of? Because if you can make it work now, when rates come down, you are going to be blissing out. And what I mean by that is things just get better, and you can grow faster, grow into that. And frankly, the profits just get better as we have QE, as we have quantitative easing. The people who were tough and building on really hard times flourish the most. So there's your tip. Obviously, again, not financial advice, but I like giving you guys things and seeing your lives change. So that wraps up our summation for our Friday real estate forecast. And hope you guys have a great weekend. It's still sunny and warm outside, so maybe go for a walk or enjoy the outside this weekend. But we'll see you next Friday, same time, same place. I'm Matthew Pohl, your host, Market Pulse Podcast, signing off. We'll see you.